If there's one thing I learned over the last few years of trading is that traders have different styles. No one does things the exact same way. So I decided to go and ask traders at interview about their day trading strategies and share them all with you today. I asked 6 traders what their best strategy is and how they do things in the market. You'll get to hear this fully in this masterclass. With these 1-hour masterclasses, we combine the best advice of traders we've interviewed into a 1-hour video you can watch or sit down to trade and listen at the same time. And this one features some good lessons of trading. I guarantee there's something you'll find useful in this video, so watch it till the end. And we'll dive right into it.
I believe that everybody who tells me you have to have a positive risk reward has, let me first make the unkind comment. Everybody who tells me to trade with a 2-to-1 or 3-to-1 risk reward ratio is really not trading. Those are not traders. Those are YouTube gurus. Because in reality, nobody gives you $2 bills for 50-cent bets. Okay, I mean they do, but that happens 1 out of 100 times. It's not about risk reward ratio. It's about your win bet ratio. In a real market, with incredibly efficient prices, incredibly efficient flows, it's extraordinarily difficult to achieve anything that is 2-to-1 risk reward more than 25% of the time, right? Run those numbers. Those are not positive numbers. Most of the professional traders that I talk to, their extreme take profit is 1.5. In other words, they're comfortable, maybe being 35-40% at 1.5. You have to ask yourself the reason why I think all of those the most fake advice you get on the internet is these risk reward ratios and the win ratios. I have a 2-to-1 risk reward ratio and I win 70% of my trades. Just think for a second what the liar is saying to you. They're basically saying to you that within a couple of months, they can take a $10,000 account and run it to about $1 million. And then within a couple of months of that, they can run it to 100 million. Within a couple of months of that, they can run it to $1 billion. Nobody in the history of trading has ever achieved 70% win rate on a 2-to-1 risk reward ratio in any kind of a high frequency. Maybe if you did 2 trades a year, yeah, okay, that's great. That's not the same. If you did more than 100 trades a year, I guarantee you've never done that, because the math of that is simply impossible. In any normal corporation, your profit after you sell toothpaste, your Procter & Gamble's profit is 5 cents, right? So a 5% edge, where let's say you have a 50-50 bet and you're winning at 55%, is extraordinarily lucrative and extraordinarily attractive, and far pretty much at the edge of reality of what you can achieve. I mean, high frequency trading firms have like a 51, 51.2, 51.3 edge, right? And those guys are far smarter and better and have more statistics than you. So, I always take issue with anybody who tells me that, because that's a lie. I show my account to all of my traders every single day. It's public. It's on MyFX. So MyFX, sorry. And you can see every single trade. As a matter of fact, I open up my MT5 publicly, so you can see every single trade I'm taking. And it's not pretty. It's just that you don't get those kind of risk reward ratios. So that's, to me, always the key differentiator between I know somebody who trades for a living or somebody who is just sells trading courses for a living. Those are 2 different things. And ask themselves: Are you better than Exxon? Are you even better than Microsoft or Google? I mean, Google, Microsoft, the fattest, highest, most lucrative. Amazon has like a 5% edge on all of the packages they sell to you. It's just not reality. And you're talking about markets much tougher than all those guys. All those guys dominate their markets. They're the axe, as we used to say in the old days, of those markets. You're just you're competing in the single most competitive market in the world. So you should be grateful for a 5% edge. And you're right. I think that's another thing that's terrible, because people have these horrible expectations of like, hey, if I just do this with what people tell me to do, and I should be earning, I should take $10,000 into $100,000 in 2 months. Yeah, I mean, anybody who does that is just basically gambling with a 10,000 that they're trading, and that's why it's non-replicable. Yeah, how many guys who you've seen win trading contests then go on to trade for the rest of their life? The answer to that is almost always zero. because they die. They all die in the battlefield. And what I try and do is survive for a lifetime. And that's where those numbers, that's where those skills and those expectations really come in. If you want to survive for a lifetime, you have to have a much more realistic idea of how trading actually is really done. Nothing really complicated. There's only two price actions that happen. And you need to have setups that can accurately filter for when those things have a higher probability of happening. The two price actions is continuity and reversal. As a matter of fact, there is literally no other strategy in trading, and everything from the most complicated Elliott wave structures to the most algorithmically driven high frequency trades to your basic macro, hey, let me look at the world ideas, are all a function can be reduced to just two types of trades. It's either a reversal trade or a continuation trade, right? Now, what we do and where my setup has been very helpful, and I have to really thank Linda Raschke, the market wizard, for this, because I've had her on my Trading Fest several times. And like the last time we had her on Trading Fest, she sort of, I just let her talk for like 2 hours. And she basically just gave like a PhD level seminar in intraday trading. She's been an intraday trader for like, 40, 50 years. And the most interesting thing she sort of pointed out to me was the fact that intraday trading is basically auction theory. It's just like going to Christie's or Sotheby's, in terms of, betting for art. It's always auction theory, and always the highs and the lows of the day are the most important levels to watch, right? And that's, we developed basically our reversal and continuation strategies relative to the highs and lows of the day, And, I was just thinking about this, not to wax philosophical here, but I thought it was interesting. Like, I was like, why do highs and lows of any instrument, but of course, stock index futures, which is what I specialize in, matter so much? And that's because as human beings, we're always a relative bet species. Like, we're always comparing relative to whatever is the current standard, not the absolute standard, right? I mean, I'm just thinking, like, what's the definition of happiness? It's an absolute standard. Like, if you're healthy, you have enough food, you have shelter over your head, that's absolute standard of happiness. But nobody's happy with that. Nobody's happy with that, because what you want to be is, you want to be running a marathon, you want to have the biggest house in the world, and I don't know what the third value, and you want to have more toys. None of those things are necessary for an absolute standard of happiness, but we all want a relative standard of happiness. And I think as a human species, because we're always measuring ourselves against some moving target, that behavior completely translates itself into the marketplace, where the highs and the lows become the relative barriers against which the price constantly battles all day long. And that's where we spot our opportunities and try to trade those trades. That's basically it. We have a special indicator that I have made for me that we use on TradingView that constantly shows us the fresh highs or the fresh lows made for that day. So we have that mark is sort of relative. It's always dynamic. It's moving, and when we get close to those levels, we have a series of reversal setups and a series of continuation setups that we apply algorithmically. So in other words, light price is near the low of the day. What are we going to do? Well, we have a reversal setup that's going to follow the following particular rules. We arm our algorithm once it gets into that area, and then let the algo execute once all the rules are met. And that's, it's as simple as that. And do that over and over and over again. Anything I say is only applicable to me and people who have a personality similar to me, right? So under no circumstances do I think that what I do, you should do if you don't feel comfortable with it. Because there's 100 different ways to trade in the markets, and there are people who trade very differently than I do and very well. And you need to just, we've talked about this all the time, that the single most important thing is that you need to align your strategy with your personality. Now, in my group, we actually created a banner and a logo. We call ourselves Degenerate Traders. And it's kind of a, tongue-in-cheek comment about what we do, meaning, the logo is Degenerate Traders, any market, anytime, because we like price action. I'm a person who doesn't have a lot of patience, and likes quick in and out stimulation and ample. So the other positive side of that, of course, is I have lots and lots and lots of sample size. I can within a week do 100 trades and have a good idea of where things are working, things are not working, and how to tweak them. So I get a tremendous amount of fast feedback. I'm a person that likes fast feedback. There are people who despise the way I trade and like to just simply trade, once a week or once a month. The good thing is my strategy is very scalable. It is fractal in a sense that the same reversal continuation ideas repeat themselves on much larger time frames. It's just that, I would die of boredom watching the 4-hour chart. And I mean, I went back to FX for a little bit. Kathy always drives me back to FX occasionally. And even like on a 1-minute chart, I'll lay down a trade on euro. Just to give you an idea, within stock index futures, our average duration of the trade is around 10 minutes, right? I'm in, and 10 minutes is like a long time. I'm in, and usually sometimes it results in 2 or 3 minutes. And I'm trying to do this, 5, 10 times a day, find optimal points during the day, and I'm just in and out 5, 10 minutes. So then, we started applying this to currencies, which actually works. But like on euro, the same duration is like 2 hours, and I'm like, I'm dying of boredom just watching this thing because it's like a slow motion car wreck in FX. So you have to know what you like, what kind of velocity you're happy with, and by no means, what I do is should you do if that's not the kind of if you like to go fly fishing, then my strategy is not for you. If you like to go fast on a motorcycle, then it probably is. That's kind of how I subdivide all of my traders. Feedback is a wonderful thing, right? I did a Trader Fest a little while back, a couple of weeks ago, and I had Denise Schull, who is probably the single greatest trainer of traders in the world. I mean, she teaches all the hedge fund managers. If you've ever seen the show Billions, the character of Wendy, who is like the main character in that show, the hedge fund psychiatrist, that's her. That was based on her character. So it was extraordinarily valuable to, and she used to be a former trader herself. So she isn't just a psychiatrist who teaches you how to trade. She's a trader who went back to her original, training. And so she had a tremendous amount of impact on me. And one of the things that she said to me is that I think this is great advice for anybody. There are 2 things you need to do to make your trading strategy successful. You need to trade your strategy, and then you need to trade yourself. Meaning you need to, when you're taking a journal of how your strategy is doing, you also need to take a journal of how you are doing with that strategy. Because that's the thing that people always forget. There are 2 variables in the game. There is your analysis of the market, and then your execution of your analysis. And your execution of your analysis is always 100% going to be emotionally based. 100%. I mean, one of the things is that emotion is a feature, not a bug of human condition, which is very true. And once you embrace that, once you understand that there is no such thing as discipline or controlling your emotion or any of those nonsense terms that anybody tells you, because that's literally physically and psychologically not possible in human beings. What is possible is to study yourself sort of on a kind of outside basis and understand, well, I've seen this, every day this happens and I do this, every day this particular setup happens and I get suckered into taking it because I think that that's the right setup, but it's really not part of my stuff. So once you actually start to take and classify your own behavior, your own patterns, the patterns of your personality, in many ways, I actually think are more powerful than the patterns in the markets. The patterns in the markets are actually, relatively easy to interpret, but to understand your own patterns and then modify them, because you trade yourself the way you would trade a chart. You say, well, that's a dumb setup because of course it's not going to work. But this setup, if you do it, that's going to work. Speaking about, FOMO, for example, FOMO was a huge failure of mine. And that in many ways what that entailed is that my algo has all sorts of like drop down menus for each particular strategy, but it also has a drop down menu for market, right? And anytime I used market as an entry strategy into the marketplace, that was generally a sign of my poor behavior pattern because I was chasing something. I was not letting the algo take the trade. So That's what helped. I mean, I forgot. I already forgot. I started ranting over my question was, but I think the most important thing is I learned how to trade myself in conjunction with trading my own strategy. That's really improved my overall performance. It went from me making 30 unnecessary trades a day to making just 7 to 10 qualified ones.
Well, what makes us so good is really, number one, understanding the dynamics of the market. It's a really good question. It's very tempting, especially with new traders that come in, to automatically look for the tops and bottoms. Many new traders are we're humans, right? So we always want to go against the trend, and we always want to go against the what's popular and say it cannot possibly keep on rising. It cannot possibly keep on falling. And what makes my trading strategy so great is something very simple, which is recognizing that the very simple line that the trend is your friend on both a long-term basis as well as a short-term basis. And what makes my trading strategy so effective is that I only trade in the direction of the trend when market sentiment is on my side. So if you drill that down a little further, what does that really mean? What does market sentiment really mean? Market sentiment means how investors and traders feel. So what I'm looking for is the long-term trends, for example, to be bullish dollar yen. But I also want market sentiment. I also want investors on a short-term basis to be bullish dollar yen as well. So I'm looking for, at the end of the day, the long-term and the short-term trend to be on my side. And I'm looking for the fundamentals also to be on my side. So what makes my trading strategy so great and what makes a trading strategy so great is that, number one, I'm trading with the trend. It's not that hard. Yes, you can make money picking tops and bottoms and fading, resistance levels and swing highs and swing lows. But you're going to make a lot more money with less stress on a more consistent basis by going with the trend. And, I assure you that I've done this for 2 decades. It really works. It's much easier to trade with the trend than against it. And then what works is that you want, the rest of the market to, be in your direction as well. And that is where we want to look at fundamentals. We want to look at how stocks are doing. We want to look at how bonds are doing. We want to look at how gold is doing. So having all of this in sync with your trade and making sure that you look for those things and only trade when those things are in line with the trade is what makes a trading strategy so great. But it's not just that, Etienne. A lot of it is the entry. A lot of it is the exit strategy as well. I am, I'm aware that, on a day-to-day basis, if I'm holding, usually my positions that I hold last no more. I have day trades, my swing trades. I'm much more active in my day trades. My day trades usually last anywhere from, 20 minutes to 15 hours. And what's really important about that is that I recognize with those trades that usually the sweet spot for these day trades is anywhere between 20 to 60 pips. And I try, when it gets to 20 pips in my profit, I start to try to take some money off the table, move my stops up for my day trade, especially when I'm trading right at the New York Open. For my Asia trades, I usually will be a little bit more fluid and allow them to carry overnight and maybe go for 60 pips. But if you think about it, unless it's a really, really big overnight story or overnight movement, a 60 pip movement overnight is probably the max that you would expect. So I've also been much more refined in my exit. And most importantly, when a trade is not moving my way, I'll get out. And I am ruthless when it comes to getting out of trades that are just simply not moving my way. Because based upon my technique, the trade should be moving in my direction quickly. It may not get full profit quickly, but it should not be moving in the opposite direction quickly. And so if it is, I will cut the trade. So being able to have a selectivity in your entry and then also being ruthless in your exits, I think is, and focusing just as much on both, because you can't make money if you're not taking profits, is really what makes the trading strategy great, where I'm not just focusing on the entry. I'm also making sure I bank my pips, and I bank my pips consistently. So the only thing I've added is gold. I've become more aggressive in trading euro crosses, as we just talked about. When I see a setup in euro Aussie, euro Kiwi, euro CAD, Kiwi Swiss, Aussie Swiss, any commodity pair based currency, I will usually lean more into them. I will be much more apt to take those trades because they work the best for my trading strategy. I will avoid trading, for example, sterling, because sterling I've learned is just too volatile for my strategy, and that includes all of the sterling crosses. But I've also gotten to trading gold, and gold works very well with my zip trading strategy. Zip also works really well in the indices as well as Bitcoin, but I think for me it's just a matter of focus. It's very hard for me to focus on all of the Forex instruments, as well as gold, as well as Bitcoin, as well as the indices. But my trading partner, Boris, through the years has changed a lot, and he actually doesn't trade Forex anymore. And he specializes in trading Bitcoin, the NASDAQ, the ES, DAX, as well as gold. So, we definitely have our strategies have become much more refined in those instruments as well. But I think he finds and I find that it's very difficult to split your focus. And Forex has long been lucrative for me, and long been the market of my choice, and the what's generated the most pips for me. And so why change what's not broken, right? And that's why I focus exclusively on Forex, but I do trade gold as well. It's always a good idea to try demo first. But there's nothing like real trading, because when you're demo trading, it's very different from the psychological aspect of real money. Even if it's not, even if it's a small amount of money that you've put in, like a prop account, adding the psychological element makes a huge difference in your behavior in trading. So I think that there is no replacement for real trading, and that demo trading is a good start, but it is only going to get you so far because it's not real money. I think that technicals will always, and chart reading will always be the way most traders start, because it's the simplest, right? I mean, you learn a strategy, you learn a pattern, and you look at it in the charts, and you hopefully, learn how to make money from there and just repeat it over and over again. But I think that what people will discover is that, while the technicals are, interesting, that, that a lot of times they're not the technicals are basically trading the past, right? And fundamentals are about trading, what could happen in the future, and what's understanding the big story and understanding the general direction of where these instruments are headed in the short and in the long term. So I think people are starting to realize that it is very, very important. I have a YouTube channel that focuses a lot on fundamentals, and I'm seeing so much interest in it because we have so many big stories. And when people start to learn the importance of market correlations, how you can use bonds to trade Forex, how you can use stocks to trade Forex, how you can use Eurodollar to trade gold, they start to see the market in a different way. And in the very beginning of this conversation, Etienne, I talked about how what makes my strategy so successful is that I'm a trend trader. And the trend is determined by fundamentals. And, I have a certain fundamental view that is determined by what's going on in the markets that will oftentimes not change. I mean, fundamentals do not change day to day. Fundamental, either economy is doing well or is doing poorly. A war does not end in a day. So these are stories and things that you learn about and you understand that will impact the markets for days, weeks, months at a time. And when you have that in the back of your minds, then you kind of lean into it, meaning that I will only take the trades in the direction of fundamentals. And that's why, we hit, I think, 9 out of 12 winning months. And, my accuracy with my trading is so high because I focus only on trading the setups where fundamentals are on my side. So I think people are waking up to that. They want to learn more. They want to be able to understand the big stories. And it's what really makes trading interesting too, which is that you're seeing these stories in the news and you want to learn how that affects your trades. That affects the stock market. That affects dollar. That affects oil. That affects gold. But how do you turn that into a trading opportunity? I talk to a lot of technical traders, and they'll even say to me, off the cuff, yes, my trade was affected by the US CPI report or the non-farm payrolls report. All of that is fundamentals. They may not be acknowledging it right off the bat, but they are looking at minimally the calendar and incorporating that into their trade. And even when these technicians don't acknowledge it, fundamentals is always a part of your trading. And you will only become a better trader when you understand even the simplest aspects of fundamentals. I mean, in many ways, if you put too many indicators in your charts, you can convince yourself of anything. I think technicals are oftentimes subjective as well. Yes, I mean, of course, fundamentals are subjective because they are, when you read about something, it's about the person's opinion. But if you have the right people, the smart people to follow on social media who know how to interpret fundamentals correctly, it becomes less subjective because, most of the people listening to this podcast won't be able to understand the right takeaways and fully analyze the fundamentals in the way that it should be. But it's not hard to do so if you read Bloomberg.com or if you look at Reuters.com or Wall Street Journal. They will explain the main takeaway to you for today's non-farm payrolls report, for example. So, go to the experts, go to the media. You can follow me on Twitter, Kathy Lien FX, but I'll be honest, I do not do data instant insights as regularly as some other people because, it's not my job. I'm trading oftentimes. So Forex Live is really good. Also, V Patel FX, I like a lot. He does really good analysis. ING Economics does a really good job. And of course, Bloomberg and Reuters, they do some instant insights. So there are ones who more religiously report on data and give you instant reactions that you can follow. You can also just look at who I follow on Twitter and kind of curate, that because that will allow you to see, who I like instant analysis from. Also, New Squawk is really good. Financial Juice, the people whose job is to analyze data. I'm not going to change what I do. I don't think that on a year-to-year basis, the themes really affect my trading strategy. It should not, right? I think my strategy is still going to be focus on the trend on a swing and day trading basis. And the trends and the stories will determine the trends. The story of whether the BOJ truly comes out of ZIRP, of who is the first central bank to lower interest rates. Those things will determine what I trade. Because I always say fundamentals determine what you trade, and technicals determine when you trade. So, I'm going to be watching the themes, and I'm going to use my technicals to time my entries.
Really, the basic principles are there. And one of the best things I found early on in my career was Stan Weinstein's book, Secret for Profiting in Bull and Bear Markets. And basically, it drove into my mind that, you don't buy stocks in downtrends. That has saved me kept me in the business. I've seen so many people get blown out or, go have to rebuild and come back buying stocks in downtrends. So that was really the first and foremost thing is I only buy stocks that are in a primary uptrend. I wait for a pullback, and then, I've refined it in terms of the time frames I look at, the time I'm willing to hold a stock, and then tools like the anchored VWAP, which has really become much more critical to me since about 2015 when I convinced TC2000 to add that to their trading platform, to their charting, that is. So I'm going to stop selling, and the buyers get a little bit more aggressive and start buying the offers, and then momentum begins from there. So it's just a fascinating tool to really look at. And first you have to understand that market structure and how money flows in a cyclical way, through the market on all time frames. There's all kinds of traders at SMB. SMB has guys that have been there, 10, 15, 20 years who are extremely successful, but they're always bringing in new guys who are, trying to learn right from the start. And the great news for them is they're learning from a structured environment. So, someone at home might just say, hey, I'm going to start trading. I'm going to read a couple books, watch a few videos, and just kind of do what I want to do. Instead, they've got, teamwork, and they work on those together. They break into little pods, and they say, here's your group. Let's work together. Let's analyze these stocks. So it's more that you've got, extra sets of eyes. They struggle with the same things, though, buying when the stock's up too much, thinking the stock is down too much, trying to catch a bounce, and that sort of thing. It's all the same things for everyone. I mean, you go look at the biggest hedge funds on the planet. They're not immune to the same mistakes you and I make. Each person, I mean, some of them are super, into their, their playbook, as Bella's book, you make your play, your one good trade, make your playbook and know what your plays are. But I think that, similar to mine, I consider myself a discretionary tool, but I have a lot of guidelines. I don't necessarily have rules that I have to do this every single time something does that. But it's more, okay, now we're in this area. Now I'm going to use my mind to think about what's the overall picture in the market. Does that support this? How's this sector acting? And just the little nuances that you get from, having a lot of experience in the market. So there's, rules based, but not always 100% adhered to. More guidelines is what I like to call it. And I kind of knew that I was a trend trader. Part of when I was working at Lehman Brothers as a broker, I was working for a senior broker there, and he would buy stocks of companies that reported better than expected earnings and had a good chart pattern to go along with them. And I remembered him just doing really well with that for his clients, much better than the other brokers in the office. So that kind of set some of these principles in place. Then I found Weinstein's book. But I've tried mean reversion trades, and I've learned the hard way that I lose money on those net on balance. I tend to get too emotional. I think, well, it's going to hold this 20-day moving average. I'll buy some. Oh, it didn't hold that. It's at the 38.2% retracement. I'll add a little. It's got to hold there. Then it goes down to the 50-day moving average. Well, this is clearly the bottom. I'm going all in, and then it keeps going lower and end up puking it out and taking a huge loss. So that clearly does not suit my personality. And I don't think it suits most people's personality. It's a way of looking at, hey, maybe I can catch a quick move if I get that reversal right. But, 7 out of 10 times I wasn't getting them right, and, experiencing losses. So that's how you learn your styles, through trial and error, I think. And, the key is, to do it with smaller share size until you get to the point where you recognize who you are in the market. One of my favorite phrases is, if you don't know who you are in the market, if you don't know who you are, the market's an expensive place to learn. So, keep it small, keep it light, figure that stuff out. The market will be here. There's no hurry to get involved. So just keep it sane and learn and practice on small sizes to start. When people look at my charts, they say, well, what do you look at? And I said, price, volume, and time. Those are the three most important. So only price pays. Volume tells us the emotional intensity, commitment. Time is subjective, but it comes down to those three things. So, the only thing on my charts is those plus some simple moving averages and anchored VWAPs. I've looked at all the other pieces, the stochastics, RSI, Adams Pitchfork, sunspots, you name it. And always be curious and willing to learn, but keep it simple. There's a phrase, I forgot who said it, but simplicity is the market's greatest disguise. That, it's just like losing weight. How do you do it? Well, you're more active and you eat less. But, people can still, sell billions of dollars worth of this new program to help you with it. Each year, there's a new fad diet that is willing to be sold because people want shortcuts. And the shortcuts aren't, how you do it. You do it by keeping things simple and focusing on what matters. The thing that matters most is price. That's why I always say only price pays. Because at the end of the day, you can come up with 100 reasons why you thought the stock was a good buy. If the market doesn't agree, then your opinion just does not matter. It's difficult because there's so much information available. And there's so many people passing themselves off as experts. And there's some great young people out there who've done a lot of good learning about the market, and they have 2 to 3 years of experience. And I see them getting, hundreds of thousands of people following them on Twitter. And I look at it and say, these people are book smart about this. And that's a great start, but you need some trading experience and to really get in there and understand the nuances of what's going on in the market. So to me, it's, it takes time. It's about finding your personality again in the market, your time frame. I'm most comfortable with the shorter term time frame. I call my shorter term time frame, anywhere from a couple days to a couple weeks, ideally. That's where I am at my stage in life. My real active day trading days are behind me. It doesn't mean I don't do some once in a while, because I still have that skill set, but it's just not in my personality anymore to really be interested in sitting down and battling it out every day for 20 cents here, 30 cents there. You don't have someone there pushing you. So you sounds like you speak highly of SMB, and I think very highly of them as well. They help recognize the talent, and they'll push you, buy more, get involved, go heavier. You're there, have confidence in your trade and that sort of thing. It's easy to become complacent in where you are, just doing it by yourself. So I think everyone should, could benefit from a performance coach or someone outside of yourself to say, to look objectively at some of the blind spots that you might see to yourself and say, hey, well, why did you get involved in that trade? And it doesn't even have to be someone who has a lot of trading experience, just someone who's a good performance coach. It could be, someone who's, been trading athletes and that sort of thing, but has a good mind for performance and breaking through to new levels. That's, outside resources are the best way to do that. Find a strategy that makes sense to them. And if it helps them make money, refine it to their personality and their time frame, and have one or two bread and butter type of, strategies that that you perform well at and can kind of consistently go back to, but always be trying to, try new things. But when you try new things, look at them with, much smaller share size and recognize you're outside of your normal, you're outside your wheelhouse, as they say, and that, it's time to go slower here and recognize there's greater risk because you're in uncharted territory. This is new to you. So go slow. Don't be in a hurry. Getting the education that makes sense. Consider the source of where you're getting your information from. Is it somebody who's just read a lot of books and is basically writing a book report? Or are they people who've, been involved in the market and coming up with new things and learning with their own money? That to me is what separates, what the good advice is and what the bad advice might be.
I get asked by traders. I've been dealing with retail traders for many years. Before I even started Forex Analytics, I had a community at MB Trading and at the Wise Trade group of traders that they've been in my chat rooms for literally 20 years. And I've seen people come and go. And I'd like to believe that I can teach everybody how to trade, but in all actuality, I think there's some people that are just incapable of doing certain things or, buckle under pressure. There are certain things that I believe that take experience, but what I've always focused on is that you have to be disciplined. You have to have great risk management. You have to, You have to be able to shift gears when market sentiment shifts. And a lot of that is from experience. What we always choose to, or what we try to do as a group, is we try to reshape the bell curve. If you have a bell curve, it's like, okay, you spend 10,000 hours in front of your computer trading, you're a professional. Great. Okay, fine. If we can make it that you spend 3,000 or 5,000 hours in front of a computer, but you really get the gist of it, and you can kind of cut some corners because you learn from senior traders that have been doing this for so long, guys that have traded on bank desks, or guys or gals, that have been in the business. They've had ups and downs. They understand the struggles, and they can teach in a proper manner. I think you can cut some corners there, but there's a lot to be said for experience in the markets. First of all, whenever you're adding to a position, it should be, unless it's pre-planned. So this is I've seen so many traders lose so much money because, some, like, an asset they're trading is going down, and they're like, and they're long, so they think it's going up, but it keeps going down, so they just keep adding. It's what some people like to call martingale strategy. Eventually, you average in so much, by the time it turns, you eventually make money, right? That's a very, very, very flawed system to trade. Anybody that's ever tried to do that, I've just watched blow up time and time again. However, if you pre-plan your entry, like, I'm buying here, I think an asset's going higher, but I'm going to buy here, based on Fibonacci's or support levels. You think this is a really critical level that you want to buy something, but you're not really too sure if it's going to make it all the way down there. So you want to buy at a couple of different levels. As long as you're adding while it's pre-planned, that's fine, because you know what your exit strategy is, and that's key, right? Knowing, okay, if it reaches this level or below, I have to exit everything that I bought. Well, you already know in your head that is the case, and you should already have a good understanding from a risk management point of view, what your loss is going to be. So that type of adding is okay. I try not to add to losses unless it's been pre-planned. What I like to do is I like to add in momentum when something's working for me. But to answer your question, how I do that is really simple. I ask myself, would I get into the position now if I didn't own it? So let's say I'm buying the euro and it breaks out above, let's talk realistic scenario. Let's say the euro finally cracks 120 sometime later this year, and I own it at 117, where we're at right now. When it's at 120, if I can sit back and say, you know what, if I didn't own the euro right now, would I buy it? And the answer is yes. And then, how would I manage that trade? I'm going to trade it, that independent trade, just like I would trade anything else. Make sure I got good risk management. Okay, what's my exit strategy? And as long as I can do that, then I'll add to a position. So, as far as risk management goes, when you're adding on positions, I think that's a very personal question. I think you and I, or anybody else listening in, and we all have different views on risk. I think a lot of it is really deep rooted. It's how you grew up, how you view money as a whole. I come from a very modest background. I grew up, I would say lower middle class America, and that's how I grew up. I didn't grow up really wealthy, although I've traded with a lot of traders that grew up in right outside the city, and they grew up, on yachts. So the way they approach risk management is going to be different than the way that I look at things. So, like I said, I think it's a very deep issue, but I always ask myself from a very simplistic point of view, You know, am I okay with that loss? Like whatever I'm risking, you know, whatever position I'm in, I always think about what the worst case scenario is, because the worst case scenario will happen. I'm not saying it's going to happen in that trade, but it will happen. I take losses just like everybody else. So what is my worst case scenario? What's my exit strategy? If I get stopped out of everything that I just bought because I'm adding, am I okay with that loss? And I'll know really quick, because if I can't sleep, if my mind is just constantly thinking about my positions and what I'm doing, that means my position size is way too big. And I do get in those situations, Etienne. It's not uncommon for traders to get in uncomfortable positions. But if you ever feel uncomfortable, then you need to bring down your size, not add to your size, right? For any trader that's listening to your podcast, I'd like to say it's not easy. Trading is not easy. You can simplify things and make it easy to a point where you have a simple system, whatever works for you. And I always try to tell people that what I do and how I trade doesn't necessarily mean you should trade that way. It's what works for me. There are 1,000 ways, as the saying goes, there's 1,000 ways to skin a cat. There are 1,000 ways to trade the market. You have to find what works for you and what you're most comfortable with. But I will tell you that if you take big losses, you will never succeed in the markets, because you can't trade if you don't have capital. That's a fact. You can be an observer. You can sit back and go, wow, I wish I would have bought the euro there, or I wish I would have sold the S&P there. But unless you have capital to trade, then you don't have anything. So that goes back to what I was saying earlier. One of my biggest, and I have to try to reinforce this with everybody I talk to, one of my biggest lessons I ever learned was just 10 years ago, was keep my losses small. Don't let them be big, because trying to make back money you lost is lost time. Not only is it lost money, but it's lost time. So keep your losses manageable. That means if you're wrong, get out. If your idea is wrong at the moment, get out. Doesn't mean it's a bad idea. It just is the wrong time.
Yeah, so I actually worked on an equity derivatives desk in London, so it was a lot more futures and options based. Whereas now I'm sort of trading, indices, FX, that sort of thing. So I have developed my own strategies, and I would actually even say, I've been trading independently 10 years now. The strategies that I used when I first started to the strategies I use now are different as well. So like my trading's evolved and that, but yeah, so the mindset and everything like that was a thing, but I think as time progresses, I've evolved as a trader as well. I think people seem to think just turn profitable, and that's all the answers, And I think, one of the other biggest issues that a lot of retail traders have is you're undercapitalized. And I think I didn't realize this when I very first started trading either. I felt like, I had a really like a relatively decent paid job in London, and so I had a bit of money behind me. But actually, when you actually get into it and you actually crack you crack the math on what you need to be able to return a decent income, it's the realities are very different. So I think a lot of people are undercapitalized. So it's not just turning profitable. You then need to get the capital behind you to be able to do it. So I was fortunate that I get funded to trade to get the income that I need. But it's something that it's not just turning profitable and that's it. And equally, like I said, it's one of the biggest things is 1 month you might have a bit of a drawdown period, so you lose a bit of money, but you still got to pay your bills. Then the next month you make that money back, but over a 2-month period you're still actually pretty flat, so you're just making up your losses. So you need to structure yourself and your trading, and you need to treat it like a business, right? You need to structure it so that you can pay yourself, and you can do that without it affecting your ability to trade as well. So I think that's one of the biggest issues. Other than that, I think one of one of the major issues that I've come across through sort of my coaching traders is sort of, this inability to accept losses and stuff as well. So I think it's really important, or even like, not just accept losses, but if your strategy is not setting up, to be able to sit there on the sidelines and wait for that right moment to get back in. So generally speaking, like I say, I'm a day trader. I generally don't like to hold positions overnight. I found, again, it was one of the things very early in my career that, it would be the first thing that I checked when I woke up in the morning or something like that, if I had a position on, and it didn't make me, it wasn't good for me. It didn't make me feel comfortable. So I really like a day trading style where, I wake up in the morning, have no bias in the market. I can follow my routine, like, get showered, get dressed, do my mindfulness and meditation and stuff like that. Really go and sit down at the markets with a clear mind, and then analyze it with a fresh mind rather than having a bias. So I think that sort of like suits me, and it's not for everyone. Some people will need longer term strategies, like as in traders, but that was what really suited me and resonated with me. And from there, so that's sort of like what I would classify myself as a day trader. Other than that, my style is really, as I said before, identifying the really key areas of support and resistance, and then attacking those. Because by identifying the really key areas of support and resistance, I have a real structure and a framework to be able to attack the markets, because I know exactly where I'm going to be entering my trades, because I'm not entering anywhere unless it's in one of my support or resistance zones. I know where my stop is, because, if that zone breaks, then that zone of support and resistance is no longer valid. Therefore, I want to be out of the trade. And then your target is a little bit more subjective, but I have other ways of identifying that. So once you build up the skills of identifying the support and resistance, everything else becomes quite natural, quite easy to follow, sort of thing. So I guess that's sort of like, in a nutshell, would be my style is like, a day trader, price action, support and resistance. And I would say I'm very risk focused as well. Like, I'm very, very focused on the risk of each trade, very focused on the overall risk to my portfolio or capital, as you like, depending on which way you want to look at it, and making sure that emotionally, any drawdown that I go through, I'm able to like just carry on going and making the same decisions and stuff like that. So really protecting the capital and letting the system play itself out, I guess. So it does take a little while to build up. I mean, what I always the way that I teach, I guess, is you've got to look for. I mean, again, understanding the markets would be, the institutions and the institutional order flow is what moves the markets, right? That is where the big moves come in from that. So what I try and do anyway, to look for those support and resistance, is look for the repetitive behaviors, look for the repetitive areas in the market where at similar areas, the market moves strongly in one direction, either as support and resistance. Support can become resistance can become support, or you have like multiple touches. Once you can see that, and this is not just any reaction, you've got to look for those strong reactions. So you've got those clear swing points all in like repetitively. Then you can see that there's been order flow from the institutions in the market there before, and therefore there is a higher probability, and I'm not going to say there is, because, as a trader, we're looking at statistics. There's a higher probability that there's still going to be order flow there, and they're going to defend that area. And you know what? If you get the breakout, then that area can become support. It doesn't, and there can be order flow from the other side, sort of thing. So it's really, that's probably how I teach it. I mean, obviously, it's probably a little bit more in-depth than that through my courses and things, but that would probably be it in a nutshell, is looking for those repetitive areas in the market where there's been strong reactions from, because that would indicate that the institutional order flow is there, because that is what actually moves the markets.
Are you looking at fundamentals to back it up, or only technicals?
No, so I'm a believer that the fundamentals will show itself within the technicals. So I'm aware of fundamentals in terms of news releases and things like that. And obviously I have a bit of a bias, but ultimately, because I'm a day trader, the overall fundamentals may not actually really impact me on an intraday basis, because, even though you may look at the equity markets and go, you know what, the markets are obviously bullish at the moment, so therefore we want to have a bullish bias. 100% you want to look for the bullish bias. You want to really aim for the areas of support, the strongest areas of support to buy on pullbacks. But at some point, there will be a correction. That doesn't change the overall fundamental idea of the market, but there will be a period where the market retraces, and on an intraday basis I can actually have a bearish bias, even though the fundamentals say over time the markets are going to go up. So I'm aware of fundamentals, but I try not to let them impact my decision making, because I say from an intraday basis, if I let that bias affect my decision making, I can go through it can be detrimental to whereas if I go in with a sort of a bit of a fresher, clean mind, I can take advantage of all moves in the market, sort of thing. I did used to look at sort of 1 minute charts, but I just found, again, for myself, and some people like it, like the quick reactions and stuff, but I found that I like a little bit more time to make sure that I'm analyzing the markets. And obviously, the smaller time frames that you go down, spread can play a part in terms of your risk to reward and how that can impact your overall performance. So I do look at a 5 minute. I do a lot of my analysis. I would say the main chart that I do my analysis on is the 1 hour. So yeah, the 5, the 15, and the 1 hour are the time frames that I generally look at for my day trading. And I would say the majority of my levels are decided from the 1 hour chart.
I still believe that experience and discretion plays a huge part. But before you can become discretionary, you kind of have to earn it. You've got to show that you can make money as a trader, even if it's not pretty. Even if you're making just a few bucks, if you're demonstrating some consistency and your underlying trade metrics are improving by just using some very blunt entry levels, using these price levels, then you can start to factor in discretion over time. There's a great quote out there. I don't know who it's attributed to, but you have to earn your right to be discretionary. I think to be discretionary with limited experience, that's a no-go, because it's like kind of me. It's kind of like me showing up in an operating room going, I'm going to use a little bit of discretion here on this open heart surgery. I may have read the manuals, may understand it intuitively, but for me to go in and use discretion without having done any operations before, probably not going to work out so well. And I would use that same exact logic in the market. Until you really understand the nuances of how the markets work on a day-to-day basis in the securities you're trading, I don't think your discretion's worth anything. In fact, I think it will actually do more harm. So I think you have to, for me, I got many, many years under my belt. Yes, I want to start with an objective piece of data to alert me to where a trade setup is, but then I want to rely on my discretion and my intuition and my experience to maybe help me fine-tune whether or not I'm even going to use that price level on this instance. There'll be days where prices will come up to these levels and I'll do nothing because the market's not trading in a way that's conducive to that. And as a newer trader, you don't have that insight at that point in time in your career to really make that call. So you have to kind of start off using it very blunt. Okay, we're hitting a resistance level, market's a little overbought, some of these other markets are rolling over, I'll get short. That's perfectly fine. That's how you kind of earn your stripes. You earn that experience. You have to be blunt initially. I mean, old habits die hard. And, as someone who's been at this a long time, I definitely still have some bad habits. And you try to unlearn those habits as you learn new things, but it's very hard. But in terms of the discretion and the experience, I think once you get that under your belt, I think that's not something that you unlearn necessarily, because I think that's a level of experience that you've filtered over the years. I think the bad habits come from doing things because you didn't know any better. Then once you learn that there's a better way, that's an easy habit to break. But I don't think that level of discretion, unless you're not paying attention or you're deluding yourself, I don't think that level of discretion needs to be unlearned, because that's just like millions of data points in your head that I think if you've approached the market in the right way over the years, that will prove to be quite useful for you. So I don't think that in and of itself is a bad habit. I think it's the bad habits you did because you didn't know any better. Those need to be unlearned, and we all have them. That's why you'll never arrive as a trader in terms of figuring it out or have it figured out. Anytime I hear somebody say, I got it figured out, I'm like, whew, oh boy, you're about to be in for a rough ride, because the market's always evolved slightly. And we're always on that ongoing journey as a trader. That's just the nature of it. I am a diligent journaler. I'm also a diligent uploader of my trades into TraderSync software. I know every trade that I have. I've got everything very clearly defined in terms of what type of a setup it was. So I learned very quickly over time what's working, what's not working. And that may not be, let's say, a bad habit to unlearn. That may just be like, that setup doesn't work anymore. Quit trying to make it work. So you have to journal. There's something about writing it down on a piece of paper each day that creates something very connecting for me, and I've heard it from many other traders. I journal every trade that I do. I don't do a lot of trades during the day. I might do 4, 5, or 6. Sometimes, like today, I did 2. If you can't journal those trades in kind of semi-real time, you really should, because you'll get a lot of insights from that. But the key stuff really comes from having those trades uploaded and then being able to look at your trading history, based on time during the day, maybe from 7 to 8 a.m. I'm here on the west coast of the U.S. How do I trade during 7 to 8? What symbols do I trade well? What type of setups are working for me? It's like any other business. You have to go back and you have to see what's working, what's not working. How do I make adjustments? So yeah, unless you have that data and if you're not keeping track of that data, you're missing out on something that's going to really keep you continuously keeping your edge. I'm one of the people that has been doing it for a number of years. It requires a tremendous amount of work. Again, I'm stating the obvious, but I will get into some of the real, what I would consider good insights from somebody who's done it for a while. I've had my share of ups, I've had my share of downs. It's not an easy business. The key thing is, in my opinion, and I think most professional traders would hear me out here or see it this way, less is more. If you're going to try to trade every instrument that happens to come across your screen or that you see on social media, it's going to make it really hard. You have to specialize. If you go to most hedge funds or any of the prop trading desks that are out there at the banks or any of the prop desks at the hedge funds, because they all have little pods of traders within the hedge funds trying to generate returns, everybody's got a specialty. One person may trade British pound, one person may trade NVIDIA, they're very specialized. And if you're going to trade in any instrument, know that you're competing against somebody who's specialized in that instrument. And they're going to have more insights than you because they're doing it, 5 days a week, 6 to 7 hours a day. So for you to show up and go, I'm going to trade NVIDIA today. Okay, maybe you'll do fine. But that nuance of not being in sync with how an instrument trades, I think can be really a major blow. So it really requires you to have your blinders on. Doesn't matter what NVIDIA did today or Bitcoin or whatever. If you don't trade it, it's just noise, and you should discount the fact that you could have gone over there and traded it well. Maybe you could have, but just do yourself a favor. Stick to what you trade, pick a handful of instruments to trade, and trade them. The other thing you have to get really clear on is you got to trade on a time frame that's consistent with what your demeanor is, your risk tolerance, your demeanor. I know for me personally, I knew this a long time ago. There was no ambiguity about this. I didn't want to be someone who held positions for weeks and months. Doesn't suit my personality. I knew I wanted kind of that instant gratification, short-term bursts. I wanted to capture that stuff. So unless you're trading in a style that is consistent with who you are from a personality and risk tolerance standpoint, it'll never work. The two have to be they have to be in concert with one another. So I know for me, Anything I try to push past a few days or a week or two in terms of FX or, let's say, 10-year notes, I know that I'm out of my element. That's not where I want to trade. That's too long for me to wait to know if I've been right or not. So that's really important. If you can find someone who's been successful to kind of take you under their wing, and I know that's kind of hard. Nobody that's really successful is going to want to take you under their wing per se. But if you can get a few minutes of their advice and get some insights from them, that can go a long way. There's so much free information out there now on social media. It's a blessing and a curse, and I would probably say it's more of a curse because you don't know what's really good. You don't know with what that person is doing or what they're saying is relevant. But again, it goes back to maybe point number one. Only focus on a few instruments. Then maybe find a few people who trade those instruments and appear to trade them well. Their commentary makes sense. Maybe pay attention to that. But I think at the end of the day, you got to find your own way. You got to find a trading methodology that works for you, and then you just got to grind it out until you get it figured out. The problem a lot of people have is when they have a few bad days in a row, they get discouraged and like, well, maybe I'll go try to trade this way. Oop, big mistake. Being wrong is part of it. Being wrong is part of being in this business. And if you can't handle that, think about that for a while, because by jumping to another style or another set of instruments to trade, you're only going to find that might work for a few days and you're going to hit a little bit of a lull again and you're back to square one. Specialize. For me personally, I like trading the big markets because the liquidity's there and the action is there. You're going to get plenty of give and take during the day to allow you to capture a range. I think when you start to get into the lesser known stocks, if you're intraday trading, that is, you're not going to get those moves. You're going to have to be in your trades longer. And that maybe that's better suited to you, and that's fine. But I'm talking more from an intraday perspective. The bigger the market, the more liquid and the more range it is, that's where I want to be. I also know it's going to be super competitive. You're going against, thousands of traders, algorithmic traders, big hedge fund traders, big bank traders. But you know what? If you sit there long enough, you'll figure it out. And if you use objective analysis to alert you to where the trades are, eventually you'll come around and you'll figure it out. But it takes a long time. There's no shortcut by any stretch. That's a very cliche way to end my answer, but it's absolutely true.
Alright, so I hope you got some value out of this. Let me know in the comment section below what your favorite advice was from this masterclass, what you will take away and apply to your own trading after. If there's any topic you want me to cover in future videos, make sure you comment below with those. I'll make sure to get some videos around those topics. Now watch this video next if you think you'll like it, and I'll catch you back there in that video.